Hello folks, I am Jon Najarian, and this is 3 at 3. 3 at 3 every day, 3 p.m. Eastern Time. Let's get at it, shall we? All right, here we go. 3 at 3. What it is unusual option activity as defined by me and Pete, which means big blocks of calls or puts traded on the offer. That's mainly what we focus on, folks. We're looking for large accumulations of calls or puts. Calls is the bullish side, puts is the bearish side. I'll show you examples of both today. If you're new to options and would like to learn more about them, just go on over to marketrebellion.com/get started. That is marketrebellion.com/get started, and you can learn all about it. I think you'll really find, if you want to learn about stocks, options, futures, even sorry about that, pulled on this cord. Even if you want to learn about cryptocurrencies, we've got it for you. Check it out, marketrebellion.com/get started. As always, this is brought to you for informational purposes only, and I am not your financial advisor. With that said, let's get started. All right, I saw this tweet sent to me from Outdoor Laser Tag. And Ace at Outdoor Laser Tag said, hopefully you can comment on the big IWM call purchase yesterday. Yeah, they bought an awful lot of calls in IWM yesterday. And they bought an awful lot of puts in the SPY. I'll show you both right now. So the IWM, that was yesterday, the 10th. Just after the halftime show ended, they were buying IWM calls. And they were upside calls when that index was 147.64. That index fell today along with everything else. And so those calls that were purchased for 73 to 86 cents, by the time this aired yesterday, they were about 65 cents, I believe, because the Fed had spoken and the market had already started to sell off. And by the end of the day, they closed at, I think, 59 cents, Ace. So since these basically opened at 9 cents today, if you paid 60 cents and they trade 9, you lost, of course, 51 cents. Never got a chance to get out of them for better than that because they just gapped lower here on the opening today. So 50-cent loser there. If you bought them at 80 cents, then of course about a 71-cent loss. So every option that you purchased, you lost about $71 because if you paid $80 for them and they're worth $9 in the morning on the opening today, well, that's exactly what the loss would be. So if you had a 10 lot, that would be that you paid $80 10 times, that's 800, and when you exited, you only got $90 for it. So that ain't so sweet. Now let's look at the other trade, because believe it or not, there are. And the other trade was a SPY trade, SPY. As you see there, also on the 10th of June, we saw unusual activity with the spider right around 320. That's, of course, the SPY. Right around 320. They bought 18,000 of the June 26th expiration. So that's 2 weeks and a day from right now, today, because here we are the 11th. So 2 weeks and a day from today, these options would expire. They bought the 304 strike. So they bought the out of the money put strike. It was trading 320 at the time. They bought the 305 or 304 rather puts, and they paid about $2.73 up to $2.80. So let's say you paid $280 for each one of these. Let's take a look. So those today, just like the IWM didn't work out, these did work out. So let's take a look. Those 304 puts increased in value by, as of this post that I took off of Yahoo, $8 and rather they increased by $5.59. So for every one of those that you purchased for $280, you had a profit of $559, every single option. So think about that. So if you purchased 10 of those options yesterday, of those puts, for $280 a piece each option, 10 of them would control 1,000 shares of the SPY. You would have a $2,800 investment. Today, that investment would be worth $8,300. So you see that being balanced and looking at both sides, saying, you know what, not every stock goes up, and here we have a lot of puts being bought. I'm going to follow this one, and I'm going to follow the IWM, which I did, and on the IWM, I lost money. And I'm a big boy, so losing $71, for instance, didn't feel good, and I trade a lot more than a 1 lot, a lot more than a 10 lot, more like 100. So, losing that kind of money, $7,000, yeah, it didn't make my day. On the other hand, this one, a $2,800 investment going to $8,300, and again, that's a 10 lot. So in other words, the 100 lot trade, which is more in the range of the size that's appropriate for me, you have to decide what's appropriate for you, meant that I had a $28,000 investment that went to $83,000. So again, you guys got to decide what's appropriate for you. I decide what's appropriate for me. I'm just pointing out that there are bullish and bearish trades. When they're buying unusual activity in puts, we follow that. When they're buying unusual activity in calls, we follow that. Let's get to some fresh meat, 3 at 3 right now. You want to learn more, by the way, about unusual option activity, you can do just that by going to marketrebellion.com/UOA. That's marketrebellion.com/UOA for unusual option activity. Here we go, PE. So let's take a look at this one. Today at about 1:30 approximately, they were buying calls in here. Stock was $10.87. They were buying the July 1250 calls, paying 60 cents. Every option is for 100 shares of stock, so 60 cents means $60. So they bought those calls. And why would they buy those calls, those July 1250 calls? Well, because they have approximately 45 days to be right. That's one reason. The other reason is just last Friday it was trading 13.40. As you can see there, June 9th was trading about $13.30 to $13.40. So somebody's betting that maybe this one goes back into that range when we're not having a 1,000-point down day. That would be one reason, at least, to buy Parsley Energy. And I am in these calls. I'm actually in the, these are the 1250 calls. I actually bought a strike under it and sold those because I'm not asking for the stock to make as big a move when I put on that 1-by-1 bull call spread. Let's get to our second of 3 at 3 today, that being SGMO. Now, as you can see here, I've shown you the heat seeker. Which we do occasionally, just because I can actually show you the strike prices, I can show you open interest, I can show you a host of things, calls and puts. And in this one, biotech stock, we see 34,000 calls changing hands at the July 13 strike. So that's kind of interesting, isn't it? 34,000 calls, that's 3.4 million share equivalent, because every option is for 100 shares of stock. So as they bought these calls, and by the way, they're buying at the 13 strike again, July 13, so they have approximately 45 days to be right in this trade, and they're buying big amounts, large numbers here, 3.4 million. You saw the stock spiked up, came back down. It's still much higher than where it opened this morning, but trading, let's say, $11.24. They're buying the 13 calls, so you're looking for another surge in this stock. And you've paid 60 cents. That would mean, actually, boy, I'm sorry, I don't have that price that you paid on there for this one, but I think this is a great opportunity, and that's why I joined with this unusual call buying. And tomorrow, perhaps, I'll have to update as far as price and so forth. But you see here the look at those 34,481 calls changing hands. Let's hit our third of our 3 at 3 right now. Third is MITT. That's MITT. They were buying calls. They bought 4,000 June 6 calls. Now, important to point out that if we were seeing the market for these calls trading this week, as in tomorrow, it would have a 12 there because that's the expiration. Today's the 11th, tomorrow's the 12th, next Friday is the 19th. So regular expirations are the third Friday of the month. There are exceptions like Passover, Good Friday, things like that. But if it's not a holiday, generally options expire on the third Friday of the month, and some actually have weekly options as well. Now, MITT, they were bullishly buying the June 6 calls that have a week and a day to trade because, of course, today is just 1 day away from the June 12th expiration. So these, the June 19th expiration, would be a week and a day out into the future. And they're paying 55 cents, double nickel, 55, up to 60 cents. Every option is for 100 shares in here. So that means that they paid $55 up to $60 for these calls. That would give them the right, but not the obligation, to take stock from somebody at 6. It would also let them participate on any pop that we might see after a big sell-off like today. So that's why perhaps we see this MITT call activity. And there's MITT, which you can see, again, last Friday, stock was $7.50. So is it that much of a reach to see them buying the June 6 calls? No, it's kind of a retracement to yesterday, isn't it? If we see that, and you see it relatively quickly, these calls could go from 60 cents to 80 cents, $1, something like that. And if it pushes through 6 quickly, you could see much more. So, as always, what I do, folks, is I cut my losses at a 50% drawdown. If I've paid 60 cents for these calls and they fall to 30 cents, I'm out. On the other hand, if these options double, if we're talking about a stock like, for instance, the ETF for the Spider, those Spider puts I showed you earlier, I would exit half of those puts, which I did because of that doubling. When it went from $2.80 to $5.60 or more, I was able to take profits, and these went much higher than that. Those puts that I had talked about went to over $8, $8.30. So that's what you need to focus on, is cutting your losses, letting your winners run. I am Jon Najarian. I hope you enjoyed this version of 3 at 3, and I hope you tell your friends about it and tune in again tomorrow. We'll have a great show then. Thank you very much, my friends. I hope that you stay out of the way of some of the bad stuff going on in the market, and let's all flatten the fear. Bang.